Hello traders, the title of the video is Elliott with a trader dissects a silver precious metal. So we're going to start analyzing the precious metal silver. Previously, I have analyzed gold. We were talking about Elliott with trader versus gold. Today we want to talk about Elliott with trader dissects a silver, a precious gold. I'm on a monthly chart. I need to remind traders that I'm using a trading view, trading software for the first time. All right, I subscribe to them. Normally, I use TC2000. The data for gold is the data for silver. That's all I got here for TC2000. It's not sufficient. That's why I went to subscribe for TradingView, but I'm still subscribing to TC2000. I like more TC2000, but apparently TradingView has more data for gold and silver. So traders have been asking me for years, all right, no, for months, that I should analyze gold and silver and other precious metal. This is what I'm doing here. So as I explained to trader, in everything money is involved. It costs me money for the TC2000. It costs me money for the website. It costs me money for TradingView. This is what's going on. So we need your support, please. All right. Let's move on. So talking about Elliott with trader dissects silver, a precious metal. There are similarities between gold and silver because both are commodities. All right. But silver is more volatile than gold. Do we use English word petulant? All right, very petulant. All right, going up and down. Now, previously we were talking about gold. There was a trending first for gold. All right, and we saw a correction that brought the price to the sweet spot zone, the zone between the 50% and the 61.8% Fibonacci retracement level, or the prior trend. That's what we saw for gold. But if you look at silver that I'm looking at now, after that trending first, the price did not stop in the sweet spot zone. You see the two red lines here? This is the sweet spot zone, 50% and 61.8% Fibonacci retracement of the prior trend. This is zone. Though you see the surge in trading volume here, it didn't stop. It's more volatile. You need to understand the nature or the characteristic of the financial instrument that you are trading. So very volatile. But the good thing about volatility is that sometimes it can allow you to get paid very fast, but don't forget that it can also take you out of the trade very fast because it's petulant, going up and down all over the place. So this is one of the reasons why it could not even didn't even stop few months in the sweet spot zone. You just cross it like it did not exist. You just go, wow, bye-bye. All right, right below, it tests the sweet spot zone, and it just continue to go down. And the correction of silver after that trending first brought the price back to the 78. I don't know even it break below the 78.6% level. You see where my cursor is at the 78.6. It went below it. It brought it to the 88.6% Fibonacci retracement level of the prior trend. So it's almost total retracement, total erasement of the prior trend. Something that went up all the way here, cancel it all, 88% of that previous move. Very, very volatile silver. So those of you that are trading silver, you want to trade on the edge. You want to wait for the volatility to set. So why you can work with that high volatility has stopped. Now you see a bit of low volatility. You gently enter there and wait for the volatility to kick in. So when you want to join the volatility like this, it can be quite volatile. Or if it's too much for you as a technical trader, you have to use a put or call option. That's it. Or you go and buy ounces of gold. That will be a better scenario. You know that it's going to go out for a long time, and that's what I said previously, that if you know that it's going to go out for a long term, go and buy and hold it, full stop. Otherwise, they will kick you out of it, you'll lose your money, only to see that your expectation was correct. So you may go and buy and hold silver if you think that it's going to go up. because it's very, very volatile. Okay, so let's go back to Elliott wave trader, dissect silver, precious metal. So to avoid that the video is too long, this is the first wave, 1. This is the second wave, 2. This is the third wave, 3. This is the fourth wave, 4. That's the fifth wave, forming the multi-wave. The question or the challenge that we face as Elliott wave traders, do we have enough data here? Is that all? If we do not have all the data here, what we are doing here will be completely speculative. In that case, we will be very, very cautious. It looks to me that we do not have the whole data here, but we can work with what we got here. If you compare the silver chart to the gold chart, as I started already, also for gold, we were saying that the bullish trend has started somewhere in 2003, so the first wave was somewhere here. But look at for silver, the second wave that people were expecting cancel the first wave, unless there are more data here that I cannot see on my chart. So my apology to traders. If this information that I have here is true, this move down all the way here will have canceled what's supposed to be the first wave. Or if we do not have enough data and there are more information here, which means the price start going up somewhere here, blah, 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 out. So this will be instead the first wave here, and this one here will be the second wave, provided that the price start going up somewhere here before, and we do not have that data. Okay, but with what I can see on this chart, that's all I got now. I cannot call this one first wave. I will call this one second wave. All right, so that's what we are doing. But I'm very careful with the information that I have here. But something that is true that we cannot all deny is that silver was trending, like gold from 2003 to 2000. It went well up to 2011. All right, that's what both commodity did. All right, the precious metal, gold and silver were trending from 2003 to 2011. See, yeah? For gold, we see a clean-cut flat correction. For silver, this is a messy, very messy flat correction. Don't ask me what is the A wave, so probably something like this down. That's the A wave of the flat correction. Probably this is the B wave of the flat correction. You want me to put you on the chart? I'm choosing my word carefully because it's so messy, but it is a flat correction. Okay, so we will call, this A of the flat correction, and we will call this one the B of the flat correction, and the C wave of that flat correction, instead of stopping somewhere in the sweet spot zone or a little bit below it. You see people were buying as it dip a little bit below the sweet spot zone, the red zone there. See the surge in trading volume, but it found a resistance below the sweet spot zone. The first surge in trading volume, you can see the bar. The first surge, the 1, 2, 3 red bar there, those were sellers, followed by those were sellers. Those are the first sellers. All right. Now then we have more buyers that try to buy it, pushing it back above, but those buyers has failed, and more sellers came back again to sell it down. So that surge in trading volume is a combination of bullish and bearish traders. First reaction, sellers. Second reaction, bullish traders. Third reaction, sellers again. So the sellers have overwhelmed the bullish trader and they push it down beyond the sweet spot zone. Contrary to gold, silver continued to go down all the way to the 86.6% Fibonacci retracement level of the prior trend. But it's a messy flat correction. A, B, C. All right. So as I told traders when I was analyzing gold, that flat correction at this point in time, we can call it the whole flat correction. We can call it a W. Okay, so we say, that's the first corrective pattern. All right. Is this the X, or is there another X likely to pop up? I will not call this one here X. I will wait. All right, sometimes we call this one X, but all I'm saying to you, the first correct way, we call it W. We just wait. W. All right. Will the S be formed? It may not be formed. Then it will be, if the S did not form, and the price just go up and form another trending pair, we'll say, all right, 1, 2, 3, 4, 5, probably this is an impulse wave of a higher degree. This flat correction is a corrective wave of a higher degree. But the problem that we face with trading view is that we don't have the yearly chart. You see, so it's difficult for me to start talking about higher degree because we can't see the yearly chart and we do not have a bigger data to compare the lower degree to the higher degree. So I'm stuck with my monthly chart. I can't see even the quarterly chart with the trading view. For Elliott wave analysis, that's very bad. You can't work with the monthly chart alone, pretending that you are counting the Elliott wave. But traders have been asking me, so that's all I got. That's what I'm working with now. Hopefully we get, if you know another trading software that I have to check out, let me know. All right. And if you have more money, okay, we can do that, okay? So here we are. So, all right. So at this junction, the price went up a bit. Is that the X? And then pull back again. Is that the Y? Well, some traders may say, George, for now we can call it, okay, this one, X. I don't want to call it X. Just for fun, let's do it for now, okay? But then I'm going to remove it as soon as possible because I won't call it S and Y yet. In my mind, I'm not satisfied with that, so I'm not going to play with that. All right? So some people say, all right, WSY. Maybe, maybe not. All right? I remove all my line now, because that's not what I want to do. So you understand now. So trending first, 1, 2, 3, 4, 5, the lines, and then we have a flat correction. Okay. Is it going to be X? Y? I doubt it. So now my lines are gone. All right. Okay. Not very good. I'm getting used to this charting software. Ah. That's it, it's back. Oh, I've done it. Okay, getting used to it now. Just click on the undo. That's a very important button there. So they're all back nicely now for me. So here we are. So you see now? So, talking about Elliott wave forecast, we're going to look at the various scenarios that can occur after a trending fall and the first correction. All right? The first scenario may be a WSY wave. In my view, we are still expecting the X and the Y. All right? The S can go up into that sweet spot zone of the prior trend, or the S can continue to go into this blue zone, which is the sweet spot zone of this move from here all the way down here. So we have two sweet spot zones. The first one is red, the sweet spot zone of that uptrend. The second one, which is the blue one here, is the sweet spot zone of this down move all the way here. So if we're going to have a proper S, which is a failure of a trend, that should normally go at least into that red zone or the blue zone, preferably the blue zone, because it's the sweet spot zone of the down move. So the professional Fibonacci traders will be salivating or hoping that the price, okay, come back to the sweet spot zone of that bearish move down here. So this is the sweet spot zone, and then if it reaches that zone, they will be willing, they will be challenging it, try to push it back down. If that is the case, that will form the proper X. That's why I'm a bit reluctant to call this one X and this one Y. We will see. Is this the X? Is it the Y? Okay. So this is one scenario. Another scenario will be we go into the mind of Fibonacci traders. All All right. We're going to the mind of Fibonacci traders. Okay. So the Fibonacci traders will call this. So stay with me, please. We call this point here point A for alpha. I need to use a capital letter. We call this point here point A, and then we call this point here we call it the point. Attention please. All right, did you spot it? Yes, you did. We call this point here point S, and then we call this point here point A. Don't get confused with the prior drawing on my chart. Okay, we finish with the WSY. Okay, just concentrate a bit. So if you go into the mind of Fibonacci trader, we call this point here point X, and we'll call this point here point A. So as those points are in place, they will be thinking of Fibonacci pattern such as the Gartley pattern, the bat pattern, the butterfly pattern, and the crab pattern. For the Gartley pattern, they'll be talking about A, B, C, D. All right. So they'll be expecting the point B somewhere here. Not exactly, but roughly, okay? And the point C, all right. Somewhere there, so which means the price going up a bit, forming at one certain resistance level, and then pull back. Is that already here? Okay. And then they will expect it to go up one more time in a zone of 78.6%. Fibonacci retracement of SA. So SA, you apply Fibonacci retracement to it. You highlight the 78.6% Fibonacci retracement and also the 88.6% Fibonacci retracement level. XA, Fibonacci trader will be expecting the price to go up to a point A somewhere, a resistance, and then pull back to a point C, and then continue to go up to the level of D. First D level, the level for the point D, the first point for the point D is the 78.6% Fibonacci retracement level of SA at the level of 4072. If it's a Gartley pattern, you will find a resistance there, and then you start coming down. But don't forget those resistance here before and those one here before, talking about Gartley pattern. So what is happening after the trending phase? Elliott wave trader talking about Elliott wave pattern, WSY wave. Fibonacci trader will start talking about Fibonacci pattern, Gartley pattern, butterfly pattern, crab pattern, bat pattern. If it goes above the 78.6% level, Fibonacci trader will be thinking of a bat pattern, bat, B-A-T, bat pattern. The target for the bat pattern will be at 88.6% Fibonacci retracement level of SA. That level is at 4405. If it goes beyond those two key levels, they will be thinking of what pattern? The butterfly pattern at 138.2% Fibonacci extension level of AX. I didn't say SA. 138.2% Fibonacci extension level of AS for the butterfly pattern. That will be a potential reversal point for the butterfly pattern. And for the crab pattern, they will expect the price to go beyond this high here, where the point D will coincide with 161.8% Fibonacci extension level of AX. So those are the scenarios that can occur, those are the scenarios that can happen, meaning that after that trending phase, we may have either, a WSY wave, or we may have, one Fibonacci pattern in the shape of Gartley pattern, or bat pattern, or butterfly pattern, or crab pattern. For traders that are very new to the Fibonacci pattern, check YouTube search the phrase Fibonacci pattern by Day Pro Traders YouTube channel. So there is a playlist that I posted out there from Day Pro Trader YouTube channel talking about Fibonacci pattern. If you see, watch them all so you may understand the Fibonacci pattern. So those are the scenarios that are possible. So remember everything that I said before. If the price start going up from here, the first resistance is the first sweet spot zone of the prior trend. The second resistance zone is the sweet spot zone of this move down. That zone, that blue zone, is very, very bearish because Fibonacci, professional Fibonacci trader, will try to sell it there big time and try to push it back down. Where the price is now, what can we tell traders? We'll say to traders, priority to bullish signal above 1393. That's the red line here, which is coinciding with the 88.6% Fibonacci retracement level of the bullish trend. So that bullish trend brought the price to the 88.6% Fibonacci retracement level. That level is at 1393. Priority to bullish signal above that and priority to bearish signal below it. It looks like a double bottom here, but it can still break below it. So priority to bullish signal above and priority to bearish signal below that level. You draw your trend line. Now that we have done our forecast, looking at various scenarios, I'm under time pressure. That's what I'm watching it time now. Okay, you need to pay attention to the price action so you can make decision, okay, carefully. All right. So what are we looking for now? We are looking for trading sector around key level. So I'm going to place on my chart very fast. Okay, that pitchfork tool, provided that the price is not coming down, because if it start coming down, we will remove this pitchfork tool. Now it's looking like it's going up. So if it continue to go up, then we can leave that pitchfork tool there. But if it start going down, we need to remove it. So you can place that pitchfork tool on the chart, watch the median line of the lower half of that pitchfork tool, watch the median line of the upper half of the pitchfork tool, watch the median line of the pitchfork tool itself, meaning that trade around key level, draw your trend line, horizontal trend line, everything. So that's what you need to do, and you want to look for. You see there's another line there, there's a resistance there, and you can draw a median line. You need to do that yourself though, all right? I'm showing you now what you need to do. The price can consolidate between the level of 1393 and the level of 2032. You see, so people bought it here, it went up, now it come back to the same level, they are buying again. So their intention is a consolidation to bring it up to this level again and to bring it back down. So as it's going up now, okay, the first target is this midpoint here at 1682 in the zone of, no, in fact 1693 in that zone. Watch those kilo. So we have done our area wave analysis now. All we need to do now is to make sure that we get paid. That's it. So how do you get paid? By making sure everybody can know that the price is going to go up and say, oh, I know that silver will go up. But not all of them will get paid. That's what we are talking about. So this common set line is kaput. The price start going now. Implement a different time frame trading method. You see that bullish, that tendency bar is for December. So I've got a few minutes left. Okay, watch my time carefully now. So December 1. So the year will end in 4 days. So I'm recording this video late in the night. It's 1:29. Can you see that? Well, late in London now. Can you see? All right, it's not easy to record video for YouTube. All right, it's hard work. All right. So 27 today, the year we end in 4 days. All right. So what we recommend to traders, when the new year begins, let January pass at least. Professional trader wait up to the mid-February before they start placing trade all over the place. Retail trader will jump into the market, all right, without checking the temperature first. So what they are doing is like you see a swimming pool and you didn't check the temperature first. You just jump into it and you notice that it's a freezing cold. And then you're crying like a baby. Yes, it's freezing cold. But the minimum that people do when they go to the water, they touch it first to see the temperature before they jump into it. So the same thing you want to do as a technical trader, January to mid-February, beginning of the year, professional very careful. The market can be volatile. All kind of things. A lot of retail traders are taken out, they lose their money. But I'm not saying that one cannot trade during that time. But all I'm saying to you, don't splash it all over the place. Don't expose yourself too much. When you are trading during that time, be very cautious, be very prudent. Here we are talking about bullish trading sector consolidation. Be gentle, all right? The best scenario is to this kind of about to close bullishly, okay, and then January to go up a bit, and then maybe have a tail or whatever. At the end of January, we may see a clean-cut candlestick pattern, something like that, that will entice everybody, and then people can enter the trade safely instead of guessing it. Or the price can even go back below that key level in January, and then again come back and close above it. And then people will say, all right, now we retest that low because of that. They do it like this, like a trap, and then they push them back down. People say, oh, it's going to go down, and then they push it back up again. So patience and looking carefully until it's set nicely. If you are trading it, okay, in a risky way, you know what you are doing, and you want to control it carefully. So that's what we can say about silver at this point in time. So to summarize this tutorial about area of a trader, dissect silver, precious metal, there was a bullish trend like gold from 2003 to 2005. For silver, it was more volatile. The correction is a flat correction in both cases, but for silver, the correction did not stop, okay, at the sweet spot zone. It went beyond that level, and the correction brought the price to the 88.6% Fibonacci retracement level of the prior trend. What's next? That's the question. Possibility that we may see Fibonacci pattern, either Gartley pattern, butterfly pattern, bat pattern, or crab pattern. That remain to be seen. Those are just scenario possibility. Next scenario, we may have a prolonged correction, which means we may have a W, X, Y wave. So like now we see a double bottom here. The price may push it up into the first sweet spot zone or it better to the second sweet spot zone, forming the X, a trending feather has failed, before we may see a Y wave pushing it back down. All those are different scenarios that can occur. But for us, in order to get paid, we must make sure that we trade on the edge looking for a trading setup, okay, around key level without assuming anything. Let me pause the video to save time, so because I'm going to put another picture through my chart. So this will conclude our discussion today about area wave trader, dissect silver, precious metal. Thank you for watching, and I will speak to you very soon. We are the TSTW 24 traders. Happy trading to you all.